Hi, everyone. I want to thank you for attending tonight's webinar. At least it's nighttime in America. I thought this would be an important thing to do for more people who are relatively new to wave theory or maybe have been doing things wrong for a long time. There's a lot of things that most people don't realize if they're new or fairly early in the game. And even people who just never even understand that the kind of data you use to plot charts, the way you plot your charts, all these things are very important in producing good wave analysis. I didn't know a lot of this stuff for the first few years, and it was only after making important changes to the type of data I use, the way I plot my charts, and a rigid approach to the analysis process that allowed me to start discovering all the things that I did that became part of my book. So let me move on to the next page here. So wave analysis is a complicated form of market forecasting. It takes a lot of time generally to get good at it. As part of NEoWave, there's very specific steps that you should take to dramatically improve the accuracy of your counts, the accuracy of your analysis, the stability of your counts. And so that's what I'm going to be talking about today, all the things you need to do to get your analysis to improve and to be more stable and your forecast to be more stable. Because one of the biggest problems that maybe many of you have experienced is having multiple wave counts, changing your opinion on a daily, weekly, or monthly basis. You know, that's not a very scientific kind of approach if you're always changing your mind about things and always changing counts. So the goal is to show you techniques that will help you stabilize your structure, wave structure, which will then stabilize your forecast. So the process is in 5 steps or 5 different things that you need to do. And number one, the most important thing is using the right kind of data. We'll go over that in a minute. And then creating a certain kind of chart, which are called wave charts. Once you've done that, then you need to control the complexity of all charts that you use. And we'll discuss what that is. And then you need to know how to select the proper starting point for your analysis. If you begin your analysis always from the top tick or bottom tick or just from the very beginning of the chart, that's not going to produce consistently reliable results. You won't notice a repetitiveness to the way patterns behave. So starting your analysis at the right place is super important. And then finally, and probably the most important of all to keep stability going, is making sure you're integrating structure on all time frames, beginning from the largest time frame and working your way down. So we're going to go through each one of these individually. I don't think this presentation will be very long. It'll probably be 30 minutes or less, but these are foundational concepts that you must do to improve your wave analysis and stability of your wave counts and the accuracy of your forecast. So let's start with number one, using the right data. So first of all, you really need to always use cash data. A lot of times people will do analysis, say for the gold market, like I used to do, using futures data. And there's a huge problem with futures data that it deteriorates with time. So if you were to compare the price of, say, December gold right now with cash gold, there could be $10, $20 difference between the two. It's about $1 or $1.50 per month, something like that. I can't remember the exact number. But the amount of deterioration that takes place each month is at least $1 and maybe up to $2, depending on how volatile the markets are. And that deterioration will cause wave patterns to distort downward and causing overlap when it shouldn't exist, or maybe making patterns look like flats when they should be zigzags, things like that. And then the other issue with futures contracts is that they expire. So you have these gaps that typically occur, say between the December contract and say the March or February contract of gold. It can also then jump $2 or $3 or $4 or $5 from the close of the previous expiring month, because it's now in a new month where there's this extra holding cost and interest rate costs that are added on to the price of gold or whatever the commodity might be or futures market might be. Same thing happens to a smaller degree. The S&P happens to a great degree in any agricultural market. So it's a problem always with futures markets, but more so with the agricultural realm. You always want to make sure you use cash data. And when it comes to things like the S&P, You can go to services like barchart.com. You can type in the symbol ESY00, which is the cash S&P. You can set the duration to 5 days, 15-minute charts, and then you can actually see here for this particular day, let me see what day that was, August 8th, you can see the high happened first, and you can get the exact price if you look up here at the top while you hold the mouse over, and you can see the low came second. So this would be high first, low second for that day. On this day, high first right at the opening, low second somewhere around in here, and then here low first, looks like high second over here, and so forth. That's the data you want to use and the process you want to use to plot out your charts. And when it's done in that fashion, your charts will start to look like this, where you'll see an actual flow from high to low, low to high, high to low over time. Okay, so let's move on to the next part, creating wave charts. And this is what I just showed you a second ago. Once you get this high-low data, and once you've looked at your chart and you figure out which came first, then you're going to want to plot those data points in sequence where one comes before the other, and that you have them equally spaced in time. You don't want to have, for example, on this day, the high came first right here and the low came late in the day, or this one, the high came first few minutes of the day and the low came, late in the day. You don't want to have the high plotted here and the low plotted there. You want them to be equally spaced exactly between the beginning and end of each day. So if you were to divide the day in two right here, then you would have the high plotted about right there and the low plotted about right there. And you split each day exactly in half and then put each high and low right at the midpoint between the half point. So I can't draw on this chart, but if you imagine to the right, there's a space that's halfway between the two vertical lines, and one to the right that's between the two vertical lines. And that's where you want to plot your highs and lows. And once you do that, you want to connect each one of those in the order they occurred. So you're going to have your high connected to your low, and then your low of one day connected to the high of the next. So here you'd have the high plotted about here, the low there, and then the next day you would have the high plotted about right there, and then the low there. And the next day the low would be plotted about right here, and the high about right there, and so forth. And that's the sequence of events you want to have when you're plotting cash data for any market that you're following, whether it's daily, weekly, or monthly. It should always be done this way, and the spacing should always be equidistant apart. So that is the way that your charts should be created once you get the cash data collected. The next thing, which is really important, because if you don't control the complexity of your charts, you're going to have a lot of flexibility in your interpretation. If you use, say, a daily chart covering 10 years, you can pretty much pick any high or low you want to begin your analysis. But if you have the same daily chart and only covers maybe 20, 30, 40 bars, then you're going to be much more limited on how many highs and lows can actually be used to start analysis. And then when you're doing your charts in the wave fashion, where you have peaks and troughs and movement back and forth, where you can actually see wave patterns develop, you want to start controlling the number of monowaves you can see on the chart. So every time a market goes up or down, show an example of this. And let me blow it up a little bit if I can find one that's. Here you can see how it goes from high to low, low to high, and so forth. And you can see the flow that takes place. So you want to make sure that you're counting the number of monowaves. So I don't know how many are on that particular chart. Clearly less than 100 is probably somewhere in the 40, 50 range, give or take. But you want to control the complexity of your charts to where you're preferably between about 21 and 34 monowaves when you're doing hardcore analysis, but you want no less than 13 up and down monowaves and no more than 55. And a monowave, just to be clear, is the movement from high to low until it stops going up or down and then changes direction. So this would be one monowave, that's one monowave, that's one, that's one. A monowave can take multiple data points. So monowave is not just one data point, it's one continuous movement from low to high. So here I think it took 2 or 3 to go from here to here, but you can see it didn't change directions until here and there. So that's what constitutes a monowave. So you want to look over your chart, make sure the total number of monowaves you can see is no less than 13, no more than 55. Then you're dealing with a chart that has the right amount of complexity to do good wave analysis, and ideally between 21 and 34. Okay, let's move on to the next section, which is selecting the right starting point. To do this and begin your analysis properly, you always want to begin from the largest time frame that you can get. Frequently, this is going to be monthly highs and lows, but if you have the ability or want to go to the trouble, creating a 6 monthly high-low chart can be really helpful if you're dealing with really long-term markets like the US stock market, the gold market, things that have been around for decades or 100 years or more. So you want to begin from the highest time frame possible with, again, the high, not a bar chart, but with the highs and lows plotted in order in wave fashion. Then what you want to look for is the largest, most violent move visible on the chart that you're looking at on that largest time frame, and you should assume that that largest, most violent move is going to be the longest wave of the main trend. So either it'll be wave 1 of a first wave extension, which means wave 1's the longest in a 5-wave move, or wave 3 of a third wave extension, so wave 3 is the longest of a 5-wave move, or wave 5 of a 5th wave extension, where wave 5 is the longest, or it's going to be wave A of a zigzag, where wave A is the longest, or wave A of a contracting triangle, where wave A is the longest, or it could be wave C, where C is the longest, what's called a neutral triangle, or wave E, where wave E is the longest in an expanding triangle. Whatever wave is the longest and most violent, that's going to tell you, number one, the direction of the trend. So whatever direction the market's moving with the biggest, fastest movement is always the direction of the trend. And that biggest, fastest movement will either be wave 1, 3, or 5 of an impulsive pattern, or A, C, or E of a corrective pattern. So that immediately, right off the bat, gives you some starting point and something to work with. And I'll show you an example of how this can be handy. Looking at the super long-term chart on the S&P, this is highs and lows for every 2.5 years. You can see on this chart, from this high downward, we have the biggest, fastest decline at that point in time before this happened that had occurred going back decades. So I knew immediately when this happened from the high in 2000, and I was actually anticipating this high as it was happening in September of 2000. I was on national television talking about this, saying that we were getting ready for the biggest bear market of my lifetime at that point, and that it was going to be not as bad as the 29 crash, but it was going to be worse than any previous market decline up to that point. So we began this really big drop, and it took about 2 years. Part of that involved the 9/11 situation, and that was the largest, fastest decline in decades. So immediately I knew when this happened that whatever this was, it was over with, and we've now started a new bear market. So that means that this could not be the beginning of anything new, because this had to be wave A of something new. So biggest, fastest move that happened first for the very first time can't be anything but wave A or wave 1, because it's completely retraced. It can't be wave 1, so it had to be wave A. Once I saw the B wave, which I predicted in this area would go all the way back to the highs, which it did, the B wave made a new high just by a few ticks. It was a corrective, very long, drawn out, about 5-year corrective rally. Then you'll notice the C wave down was actually faster than the A wave down. So in flat patterns, you can't have a C wave taking less time than an A wave. So I knew at that point we couldn't be forming a flat, even though it looked like a flat. The recovery also was a little slow. If this were the end of a flat, the C wave should have been retraced faster than it took to form, but it was slower. So for 2 primary reasons, I knew that this couldn't be the end of a flat. But it turned out that this was actually more violent and longer than this drop. So I then had to assume either we were in a neutral triangle, because wave C was bigger than wave A and it was more violent and less time consuming, which is not allowed in flats, but is allowed in neutral triangles, or we were in an expanding triangle, which would have created the need for wave E to be the longest wave, and that has never happened. So all the evidence indicates we're in a neutral triangle where wave C is the biggest. So let me go back to the layout here. So marking the longest wave that's the most violent as the longest wave of the main trend is what I did on this particular chart. So we have the longest wave in the direction of the trend, but because they're completely retraced, it can't be a 1, 2, 3 situation, so it had to be an ABC. And because wave E never got anywhere near as long as wave C or wave A, The longest wave is the middle wave, which means this has to be a neutral triangle. And this is what I've been saying for years and years, and it continues to be the only logical interpretation of this price action for the last 25 years. And for those of you who have been with me or have followed any of my stuff for a long time, you may have heard or seen me on national television saying here was the beginning of a 20 to 30 year corrective market environment. We still are in that corrective market environment, and it's probably going to end sometime in the next 5 years or less. And when it's over, then we're going to begin the most powerful bull market in world history, and it's going to be even bigger than this rally here. So it's a very, very different kind of perspective from what you're hearing from most orthodox Elliott Wave analysts. But I've been saying this for decades. And if you look in the back of my book, you can follow up with what I was saying 35 years ago about the bull market and what would happen after the 87 crash and so forth. Okay, so after you've gone through identifying the largest, fastest move and figuring out whether it's 1, 3, or 5 of a impulsive pattern and being the biggest wave of that impulsive pattern, or A, C, or E of a corrective environment and being the biggest wave of that corrective environment, then you can move on to the next step, which is integrating information that you've determined to be reliable and follows all the rules onto lower time frames. And this is something almost everybody does wrong. Almost everyone I've ever taught, that I've ever seen or know regarding markets, who does wave analysis, always wants to begin from the smallest charts and work their way up and trying to force that structure and analysis onto higher time frames. That would be analogous to saying that the direction of a river is determined by the small streams that enter the river. You have this large river that's moving in a particular direction. A little stream that connects to it and empties into that big river is not going to change the direction of the big river. Same thing happens with wave analysis and wave structure. Your long-term structure is your guiding trend and your sort of most powerful force. The smaller trends are not going to change that powerful direction. They're just going to interact with it. And so you always want to begin your analysis from the largest time frame first, and then work your way down. Let me show some of this process. Just to go over this real quick, you want to force whatever you determine to be the most logical, best interpretation on the large chart down to the next lower chart. And then on that chart, you want to create the best scenario possible and take that structure and force it down to the next lower chart. By the way, regarding this structuring of charts, all charts should be somewhere in the range of 5 times bigger or 1/5 the size of the next larger or smaller time frame. So you don't want to have 1-day charts and 3-day charts and 5-day charts and 10-day charts and 20-day charts. You want to have them 5 times bigger or 1/5 the size to maintain a comfortable distance so that you're not looking at virtually the same thing, but in slightly more or less complexity. So I use daily, weekly, of course, is exactly 5 times a week. A monthly is almost 5 times a month. And to make up for the few days that are missing, because a month is really 4.3 weeks on average, to make up for those missing few days, we go to 6 months. And then from 6 months, we go to 2.5 years. And if you're going to go below daily, which I don't recommend, for cash markets, you want to go to 78 minutes because that's 1/5 of a day in most cash markets. If you're going to futures, which I don't recommend, then you go to 288 minutes. Okay, so let's take a look at this process on long-term charts as it goes down. So here's the big picture count that I've had for years, and the evidence on a 2.5-year chart is that wave D finished with the COVID crash being the start of wave E, because this began the largest, fastest drop in the S&P since the low in 2009. And so that ended wave D, started wave E, and wave E is drifting up. This can't be the end of wave E because it doesn't take enough time. There's rules under NEoWave that says if you have 2 patterns next to each other that are very different in time and complexity, the third one in the sequence should be half the time and half the complexity of the other 2 added together. So that means wave E has to be at least about 3 to 5 mono waves, because this is 1 and this is 7, so that's a total of 8, divided by 2 is 4. So you can't have 4 waves in a pattern, it has to be 3 or 5. So we need 3 or 5 for wave E, and then time-wise, it has to be about half this time. So this purple is very faint here, but this purple rectangle is the entire time of wave C and D, and this small purple rectangle is half of that time. So in the next, by the end of this year or early next year, we'll be approaching, I think, I can't remember exactly when this finishes. This goes until March 2025. So we have a few more years before we even get to the end of this period here. So it's going to be a while before we run out of time, before the complexity is just right for the E-Wave. But that's the big picture. So as you move from this structure, you always want to go from the last wave that's clearly concluded and started a new pattern from there, and you want to begin your analysis on the next lower time frame, generally from that point. You might restructure the last completed pattern, which would begin here on this chart. You have an A, B, C, D, and you're working on wave E. So for the 6 monthly chart, we can start with this, but our real focus needs to be right in here, the part we can't really analyze because there's too few monowaves. Notice there's probably about 13 or more monowaves from here, but there's only 3 from here. So that forces us to go to a smaller time frame to get a better feel for what's going on here. So I'm going to jump down to the next lower time frame. So here's the A, B, C, D that you see on this bigger chart. You'll notice that the C wave here finishes at the low, but when we zoom in, we can see the C wave actually finishes at a higher point because that's where the acceleration began. It bounced quickly off this low, but it didn't retrace this decline very fast, and took a long time for the market to get above this high. One of the important rules at the end of a pattern is you want to have complete retracement in the same time or less. This was not retraced completely until way over here, and it took way too much time. So we're forced to move wave C later and started at this higher low. Then from that higher low, you can see where the D wave finished, because then we start the biggest, fastest drop in a decade, and that's the COVID crash. So this is what we want to focus on as we zoom in on half yearly and 6 monthly charts. And even on a half yearly chart, it's still too simple. There's only like, 6 or so monowaves here. So we really need to go to a lower time frame. So when I move to monthly charts, I'm going to take this structure. I'm not going to look at a monthly chart in isolation and try to figure out everything that's going on. I'm going to actually force this structure down onto a monthly chart and make it adhere to the general overall outlook of the 6 monthly charts. So when I look at the monthly analysis, it's going to have to be an upward drifting kind of correction. It's going to have to indicate that the pattern is going to finish in the next few years. It's going to have to be really bullish. So we can't have a bearish monthly count with a super bullish half yearly count or 2.5 year count. They all have to integrate together. And the only way to maintain that is to force structure from this time frame down to this time frame. I actually noticed that the labeling is different, so probably should put these in parentheses. So just imagine all these are in parentheses, and that's these A, B, C, Ds here. And now I'm going to go down to the monthly chart, and we're going to focus on the last incomplete pattern. We don't need to reassess all this. All this looks good. Channeling looks good. Relationships are good. All that's been determined by the 2.5 year and the half yearly charts to be in good shape. So the real focus is the part where you can't see enough monowaves. You need at least 13. You preferably want 21 to 34. So we're going to go to our monthly chart and take a look at that. So this upwardly rising, contracting, running triangle is the pattern that you see here, but in simplified version. Here's the violent drop, the rally, and the quick drop. The blown up version of that is the violent drop for COVID, the rally, and then the sell-off since. So you can see that structure has been forced onto here. And so now all we need to do is deal with just the last incompleted pattern here and make some assessments about price and time, what needs to happen, how long it should take, and so forth. So once again, we have the same situation that we had on the other chart where we have 2 waves next to each other, A and B, that are very different in time, very different in complexity. So you use the NEoWave rule, you add those together, divided by 2, that gives us this amount of time here. And I haven't counted the complexity here, but you want it to be half of the complexity of A plus B. Don't know what it is right now, but it's maybe going to approach it somewhere over here. And then another thing you want when you're in a contracting triangle, this is a NEoWave rule, not necessarily an Elliott Wave rule. You want wave C to be almost always exactly 61% of wave A. And this rectangle was put in here way before this low is made, projecting where the C wave should bottom if it's going to be the C wave of a contracting triangle. So the fact that it stopped almost precisely at that low, and we now have a bigger rally than any previous rally since this high, indicates the C wave is probably bottomed, but we know time-wise it's not over because it needs to be about half of the time of A plus B. So we have quite a few months to go before it's over with. So now we have an idea of where we are in this C wave. To count this isn't 13 monowaves, so we're going to have to zoom in on this a little bit and get a better feel for what's going on and what's possible. There are other scenarios that you could contemplate on the monthly and 6 monthly, but there's an important rule. It's in chapter 12, page 43, I think, called the rule of reverse logic, or the expansion of possibilities. And whenever you have multiple scenarios that are possible for a market, you always want to pick the count closest to the center of its development. This will be the count that's the most boring, produces the least exciting outcome, will take the longest to finish. So it's everything, everything that, I lost my train of thought now. Everything that you don't want it to be typically. Emotionally, it's not the things that you would normally expect in a market. You always want it to finish quicker, get more exciting movement, but the facts are that markets always do less than you expect, take longer than you expect. And so this rule takes that into account and forces you to pick counts that are more boring. Okay, so let's zoom in on this structure right here. And this allows me to get a better feel for what's going on inside of this structure here. So we've now taken our best monthly count, which shows wave B is finished, wave C is forming, but it's probably bottomed, and it has a few more months to go. So we want to use that same rectangle, which is right here, and create a count that allows all those things to happen. So here you can see what looks like a zigzag. I've called that wave A. Notice the B wave is less complicated, less time consuming than wave A. That's only allowed in triangles. So for many months now, I've been under the assumption and pretty much certainty that we're forming a triangle off of this high. And we know by looking at it that wave C is more time consuming, more complicated than wave A. So it can't be a contracting triangle. And in contracting triangles, wave A would never take more time than wave B. So the only logical choice is an expanding triangle where A and B can't do this either. So a neutral triangle is the only logical choice that's left. So I'm going to put a little X in front of this C wave. I'm going to shrink the X wave just so it looks a little different. Okay, so that stands for extended wave. So extended wave C, which means it's the longest wave of the triangle. And in triangles, you want B waves and D waves to overlap and alternate in time and price and complexity. So we're getting some of that right now. The D wave could take a lot more time. And then eventually the E wave should be more similar to wave A because wave C is much bigger. It's almost 161% of wave A. So in any case, wave E could come down into this territory, but it's probably not going to break this low. So now what do we do with this information? You know where the bigger pattern began, you know where the intermediate term structure has concluded. So we don't need to rehash all this when we go to weekly charts. Our focus on a weekly chart is to get a better idea of this structure and timing and what's forming and how we can integrate it to fit with this scenario. I'm going to go down to a weekly chart here and show you the exact same count. Now this is the big picture version where it shows the A, B, C, D that we have on the other chart. Let me just re-bring that up to remind you. So here's the tiny little A, B, C, D, and then the blow up of that same structure, A, B, C, D. And this is the best interpretation. The D wave could definitely get larger, could take more time. But you can see the B wave is mostly a horizontal affair. Well, actually it could, well, no, it actually has to start here. So it's sort of a horizontal kind of affair. Looks like a flat pattern, could be something else, but it's not very directional, whereas this is much more directional in nature. So there is some alternation there. To get better alternation, it would take more time and maybe even rally some more. But that's the weekly structure that directly adheres to monthly structure that was forced down from the monthly charts. And as we blow up the weekly charts, we can get a little bit better idea of what's going on with wave D. With wave D of this bigger triangle. And remarkably, when I did some analysis on this previously, I took the time of A and B. And again, the typical relationship is if A and B are very different in time and structure, then C will be half of those. If A and B's time period is exceeded during wave C, then the next choice is you take the total time of A plus B, add it to wave B, and that projects the next possible time for wave C. So if you add A and B together, add it to the bottom of wave C here, we're now right at the point where C wave is equal in the time of A plus B. So we're right in the time where the ballpark period where a high could be made. It could go higher price-wise, but time-wise, let's say within a week or so, there's a good chance the S&P will peak here. It may not end wave D, but the peak of wave D is likely to happen somewhere in this time frame, and then start a sell-off. And because of the drastic time and complexity difference between wave C and wave A, that tells me right off the bat we must be in a triangle for this D wave, because you don't want to have massive time and complexity differences between wave A and C of a flat. So we get a D wave that has to overlap the A wave high, and an E wave that's going to fail. So the E wave will probably be similar to this rally, starting from over here, fail somewhere in this territory here, and then we get a sell-off for the final E wave decline. Let me grab this here. And the E wave would, the E wave would be finishing the bigger C wave. Let me go back to that bigger monthly chart. So remember, working on the C wave, that's probably not going to make new lows, or if it does, it'll be very, very minor new lows before we finish the C wave in so many months from now, about 3 or 4 or 5 months from now. And then once that's over, then the bigger picture tells us that we're going to begin, let me get to the larger chart, we're going to begin a rally to all-time new highs. And that's going to go into probably about mid-2023. So this shows you the process of beginning from the largest time frame, the longest term structure, taking this structure and mostly wave D here, forcing it on to the next lower time frame, looking at the last pattern that's incomplete, that doesn't have enough monowaves, and then going to the next lower time frame with that particular structure and forcing it to fit the longer term structure, and then looking at the incomplete pattern on this monthly pattern and going to weekly charts and forcing the weekly charts to adhere to the monthly structure, where wave B is here and we're in wave C, and you blow that up and you can get more detail about that. And of course, the same process would happen if we go to daily charts. We would take the very last incomplete pattern here on the weekly, because there's less than 13 monowaves, and analyze that on a daily chart. So that shows you the process of starting from your largest time frame, finding the best interpretation, which is going to be the count. If you have multiple counts, the count nearest to the middle that produces the least excitement, least movement, most boring scenario. Use that count, go to the next lower time frame, which will be 1/5 of the larger time frame, and keep doing this as you work your way down, always forcing the best count of larger chart to the next lower chart. And the most important thing is, even if your counts are different, because with more complexity, you're going to have different counts. So like on a monthly chart, you might have a zigzag, and as you go to a weekly chart, that zigzag might evolve into a double zigzag on a weekly chart. So even if the counts are different, the implications have to be the same. So if one count says you're bottoming or time is running out, then that has to be the same scenario as you go to the lower time frame. You can't all of a sudden have a lot more time and have a bearish count when the bullish count is on the higher time frame. They all have to agree basically with the same outcome, the same timing, and same direction for the future. Okay, so this shows a process of one thing to the next and how it evolves. So the first thing you want to look for is reliable cache data. Plot the highs and lows in the order they occurred on a daily basis, and then you can create that same, or use that same data to create weekly high-low charts, monthly high-low charts, half-yearly high-low charts, and if you want to go to the trouble, 2.5-year high-low charts. And if you trade really short-term, you could use high and lows, intraday, but I don't recommend. It's a lot of work, and it's probably not going to produce great results. Remember, the quicker you have to make decisions with wave theory, the more likely you're going to forget something important. So I really don't recommend using wave theory on any time frame below daily. So the next thing you want to do is, with that high-low data, you want to plot the highs and lows in order, separate them equally by time, and do it for all the different time frames that you're following. Then you want to control the complexity of all the charts you're looking at. So at least 13 mono waves on your longest time frame, no more than 55, and then at least 13, between 13 and 55 on the next lower time frame, and the next lower, and so forth, and forcing the structure downward from each clear larger time frame. And if you're, by the way, if you're not clear about what the count is on the larger time frame, there's no reason to move to a smaller time frame, because you're just going to be even more confused. You have to have clarity on the larger time frame to make shorter term analysis viable and effective. Okay, then you want to go, after you've plotted all your charts and have all these complexity control charts, you want to look for the most violent, largest move on your largest time frame, and that's going to be 1, 3, or 5 of a 5-wave move, or A, C, or E of a corrective pattern. And then over time, it's going to be obvious which one is possible and which one isn't. And then after you've done that, you want to, once you've placed labels, 1, 2, 3, ABC on your largest chart, you're going to want to take that structure and force it downward to each lower time frame. Okay, so before I forget, everyone, this presentation is being recorded by GoToWebinar, and it's supposed to automatically send you a copy of this presentation by email so you can review it later. And if it doesn't do that, it should be available on our website within about 48 hours or on our social media sites. And Magellan, did you have anything you wanted me to add here before I forget? I think I covered that about the recordings.
I mean, you did mention the book. I'm not sure if you want to talk about the fact that we have the recordings of the book where you taught.
Right, okay, good idea. So for those of you who are relatively new to wave theory, in this presentation, is sort of getting you on the right track. Because if you don't do the things I mentioned, you're going to produce bad wave analysis all the time. So to really get it to be more accurate, you have to do the things that I've mentioned. If you want to take it to the next step, maybe you have a copy of my book, maybe you don't. We have a relatively cheap recording of 12 different sessions going through every chapter of my book, 1 through 12, explaining how to use the book, what it's for, how to think about it, all the things that I've learned in the last 30 years since I wrote the book, stuff you can potentially skip. So you might want to talk to Magellan about getting that. It's $59. And for those who are already somewhat, familiar or advanced with their wave analysis and want to really get into it, we are starting a class on advanced NEoWave analysis. It's currently scheduled to start September 7th. And Magellan's email address is down here at the bottom. You can email him and ask him about the cost and the times and all that, depending on where you are in the world. So that, I think, is the general overview of everything. Let me just give you this sort of closing summary. Wave analysis requires a lot of discipline and patience, waiting for the right setups. You have to be very confident when you're at major extremes, because the public and the media is going to be telling you something completely the opposite of what you really need to be doing or believing, such as the peak in Bitcoin, I think it was 2018 or 19, where everyone in the world was buying Bitcoin and thought it was the best thing ever, or at the peak in 2000 when the stock market and the .com bubble was busting. You're going to have a lot of self-confidence to overcome the kind of onslaught that you're going to get, psychological onslaught at extremes near bottoms or tops. So wave theory allows you to do this as long as you objectively apply the rules. So the rules we've covered today will help you to dramatically improve your analysis, but you still need to know and learn the concepts that are in my book, and at the very least basic Elliott Wave concepts to take your analysis to a new level. But it can't be done unless you begin all the things that implement all the things that I talked about in this presentation. If y'all want to go to our website, it's neowave.com. Anything you want to say, Magellan? I'm going to go back to the other page to show.
Yeah, we do get a lot of questions for you about why you haven't written a new book. If you can just address that quickly.
Okay, well, I mean, my book was it was like a 5 to 7 year ordeal of writing and taking notes. And I feel that probably 90 to 95% of everything that I've discovered about wave analysis is in my book. Only a few new patterns started to evolve after I wrote my book. So all that information is now on the website. If y'all go to neowave.com, I can show you. Up here. I don't know if this is the right one. I think here it is. So you go to the site and you go to the resource section here, and you can go under questions and answers, and there's videos probably on this too, and interviews. You can do a search on the question of the week section. Scroll down a little bit. It says right here, search questions. So if you want to learn about diametric patterns, which is something new since I wrote my book, you can type that in and read all about diametrics, all about symmetricals, and all these new variations or new patterns that evolved, but really only new patterns that were diametrics and symmetricals. Everything else was a variation of an old pattern, like a C wave being the longest wave in a triangle, which creates a neutral triangle. The third wave being the longest wave in a terminal pattern, which creates a third wave terminal instead of a fifth wave or first wave terminal. So though there were very little changes, the only thing that was really big and different was the realization that there was 2 new patterns, symmetricals and diametrics, and I just didn't want to go back and rewrite my book. And my focus for the last 22 years now has been, after I worked on perfecting wave theory, I got much more interested in learning how to perfect trading and investing. So for the last 22 years, I've been really focused on perfecting Neely river theory, which is a trading technology instead of a forecasting technology. Even if you're good at forecasting, doesn't mean you're necessarily good at trading. So there's sort of different kind of skills. And it took me over 20 years to realize that. So now I have the forecasting end of my business, which produces the forecasting service, and the trading end, which is primarily based on Neely river theory. And it's a much more objective, unemotional way of trading that has nothing to do with beliefs or forecast or, wave theory at all. So that's why I haven't gone back to revamp my book. It's just not where my focus has been. And I think I put in, 95% of everything I know in the book. So the only thing that's added would be things you need to look on the website for extra little different, additional information. Or if you take my advanced wave class, then you'll learn all the little techniques that I've picked up since I wrote my book. Anything else, Magellan?
Nope, that's pretty much it.
Okay, well, I want to thank everybody for joining the meeting today, and I hope you enjoyed it. And again, you'll get a copy of this, hopefully, and if not, you can go to the website and get it in the next couple of days. Thanks a lot, and y'all have a good rest of your weekend.